Our guest this afternoon is Peter Fahey, Managing Director of Clarence Property Corporation. Peter, thanks so much for your time. Take me through the Clarence Property business in terms of your risk appetite and investment mandate.
Thanks for having me firstly, but with our funds management business, we have a few different funds. Our biggest fund is what we call the West Lawn Property Trust, and its mandate's fairly broad. We're not sector specific in any way, so we buy shopping centres and office buildings and industrial properties, and we do land subdivisions as well. So the risk's probably orientated 20% to development and 80% to investment property. That investment property can be also separated, the blue chip passive ones or the active ones that might be vacant or might need leasing up or might need an upgrade, and so we take on a bit of that as well. So each one's slightly different, but mainly when we're trying to assess the risk or the mandate, we're trying to stick to things that we understand. So it might be the deal of the century, but if I can't work it out, I don't buy it. And later on you go, geez, that was a good deal, I just couldn't see it at the time. And then later on, other times it just hits you in the face and you just go for it. And if you talk to too many people, they try and talk you out of it. But I say, no, I understand how that one works. I want to buy it.
Now, the business has over $500 million worth of real estate under management. Talk to me about how you've seen the past 12 months. Have you seen any acquisition opportunities that wouldn't have arisen had it not been for COVID?
No, we haven't had any COVID opportunity, I don't think, other than we had to be like everybody else with the tenants. So we had at the time 280 tenants, and there was the initial period of uncertainty. And so we just jumped in and did deals with all of our tenants quite quickly. We were quite generous with all the mum and dad type tenants to try and placate any fears they had. And then with the corporate tenants, well, most of them just stuck with the legislation stuff that came out. Others thought they were big shots, and so we just contest them as within the bounds of the rules, and kept going. So we didn't see any buying opportunities. We were busy fixing our portfolio up. Then we just kept buying as normal. Then there was no distressed stuff coming on the market, and so we just started buying it, and it became clear that not everyone was affected. If you weren't in travel, or you weren't in airlines, or you weren't in airports, you all did okay. So we had one tenant not reopen who was a travel agent, and they were going to close anyway or sell their business, so they just shut down and we let them out of the lease, and the next door tenant took their spot. But everybody else went really well.
Where are you finding the greatest opportunity for investment in the current environment?
It's difficult to find anything. So I go back to just using, and a lot of the transactions are off market. So you've just got to dig in and pursue the ones that you like the look of. You've really got to set a record price to buy something, so it's a new record every time. And we've bought this year 5 smaller land subdivisions in different areas in northern New South Wales. But each one of them we've paid more than what normally you'd pay, but the land price has gone up, so you balance that out, and that's the only place we feel that there's opportunity, but that's quickly finished now because it's all supply constrained. We bought last year off the COVID 7 different industrial properties in Brisbane, but we just had to compete on the market for them and pay the market price, and they've all turned out to be quite good acquisitions. So we bought 1 retail centre in Townsville, and we bought a couple of regional properties. We bought a medical centre in Tamworth and an office building in Dubbo, and we're happy with all those.
On your retail investments, how do you build strong relationships with tenants? What's the key ingredients?
It's a bit of effort. You've got to. Our centres are all neighbourhoods. I think the definition is, I call them medically grocery anchored medical centres. Some people call them daily needs or whatever, but we've seen a big switch to medical. But the smaller tenants take some work, and often they're mum and dads, and they've got everything on the line, so you want to try and help them best you can. We've even gone as far as, in some cases, hiring a business coach, the centre has, and offered it to the tenants. And not every tenant's appreciative of it. Others take it up and don't do any good. But most of the ones that take it up do extremely well from that. But then once we finish paying, they don't keep the business coach on. So there's probably a big, in that world of mum and dad operators, there's probably a big training regime that's available to help them get better. But we did that, and that was successful, because we don't want empty shops, and replacing tenants all the time's hard work. So if we can keep a tenant and keep them growing, and their turnover grows, well, we can charge them a bit more rent.
Has the tenancy mix changed, or is it too early to tell?
We were on a pathway to that medical thing. You get the bulk billing GP doctors in, your chemist kicks up, they get a bit bigger. You get the blood doctors and the physios and the dentists, and dentists aren't hiding up the top of some old shop these days. They're down in the forefront doing it. So all of those tenants have come in and replaced what were the old retailers, people with clothes shops or that type of thing. The news agencies that have contracted into little tobacco and lottery shops. They're still there, but they're contracted in square metres away. Yeah. But in the regional areas, finding food operators is tough, good food operators. That's super tough.
What are the fundamentals that you look at or analyse when purchasing a new property or making a new acquisition?
Well, return on equity is a good start, but we other than return on equity, if you're looking at how we look at whether we can sustain it, so I always like to look at the rents first to make sure the rents aren't cooked. So therefore, if you do lose a tenant, you're able to replace them within the bands of reality. So I like to go through the rents and the tenant mix. We've got parameters somewhere. I can't remember exactly what they are, but I like to like the property first and then get into the analysis.
On locations, you mentioned northern New South Wales, I think earlier, in regard to a couple of land subdivisions you're doing there. Are there any markets that you're actively pursuing at the moment or actively avoiding?
No, well, if you look at our history, we're predominantly northern New South Wales and southeast Queensland, because that's where we live. So there's no more science to it than that. And you've got to have people on the ground where the properties are. So if we concentrate on northern New South Wales, but you quickly run out of things to buy there. It's not that big, and so you've got to go to the Gold Coast or Brisbane. And we've had a lot of properties in Brisbane over the years. We've had some in Sydney, but Brisbane really is where we try and focus all our industrial properties in Brisbane. And so we'll just keep focusing on those markets with a little bit of a outside look, like our Townsville one or our Tamworth one or our Dubbo one, when we think it's opportune.
What are the key trends or patterns that you've seen in the industry recently?
Well, in our industry, in our businesses that we've got, the evolution of the specialty tenants in your shopping centres to that in the regional areas and the neighbourhoods towards that medical section, so probably, at a guess, 40-50% of our tenants in those centres are medically linked. And so that's a distinct trend. The industrial properties they are what they are. There's probably a tiny bit more distribution than before, so you get heavy manufacturing and they just stay there. So as long as you look after them, it's a big deal to move. So unless they hate you, they'll stay on. We've sort of downscaled. We've had a few big multi-storey city offices, but now we've got smaller ones like this, where you've got your own air conditioning, you've got your own parking, you've got your own suite, and you've got external air. And so it's a nice condition for staff to work in. So we don't have anyone panicking about breathing someone else's air or having to share lifts with people. And so we just haven't participated in that thought. And then in our residential property, I suppose the trends there's been to smaller lots, really, from the 700s to 600s to 500s to 450s to 400s to 300s. So that's you know, an industry-wide trend. That's just not specific to us.
You mentioned office there. Is this sort of environment the future of the office, do you think, with the suite, the sensible parking, not necessarily in a city?
I don't know, but I'm not a city guy, so I've never, you know, I've had minimal experience of. I've never lived in a big city, and you know, I've had offices in Brisbane in the CBD from time to time. So I don't really know if this is the future. It is to me. And so I suppose if it is to me, that's the type of thing I'll play in and leave the inner city stuff to the people who are specialists in that. But whether there's a trend to modifying how buildings are air conditioned, I don't know. You see that in the hotel quarantine. They say it's coming through the aircon. So does that mean they'll have to modify the system so it's on your floor and you're not breathing air from level 17 and level 22 into your floor? You've got your own air coming in. Whether that's realistic, I don't know, but that's a possibility.
Funds management business, have you seen any substantial increase or decrease amongst investors in terms of demand?
No, I've seen a significant increase. So I would assume all the other fund managers would have seen the same. Everyone gets their money slightly different ways and off slightly different people in slightly different areas. But our investors, the demand's gone up. So a lot of them might have money in the bank and a house and not many other investments. So either they leave it in the bank or they give it to us. And as the rates went down, and they're getting down to 0.5% or 0.25%, they're actively pursuing us to get involved. And we've sort of running a long-term game. So I started this in 1994, and every investor I had initially has never taken a dollar out. So their money's still there from 1994, and they've only ever added to it. And because we pay monthly, they might know what return they're getting. They might know how many units they got. They know how much they're getting per month, though. So if I varied that and wanted to attract their attention, they'd be all on the phone. So the investor demand's up there. And my observations, you know, they got burned, a lot of them, by financial planners back in the day when they were all commission driven. And so there's a distrust of financial planners. If they're not from the cities, they won't know any stockbrokers, so they're not in the world of shares. So, you know, the share people are into the shares, and so a lot of our guys will be older and they had their own real estate properties, and as they sell them out, they look for somewhere to put the money in a familiar product. So they come to us, but the demand's certainly gone up as interest rates went down.
At the business 27 years ago, what was the impetus for starting the business, and tell us a little bit more about your background?
I went to Cat&Ag College and did valuation back in the very early 80s, and from there I went to work in the State Bank of New South Wales, and I worked out west. I worked in Dubbo and as a valuer, junior valuer, and from Dubbo you did the whole western half of New South Wales, out to Burke and Cobar and Ingham and Canamble and Walgett, and you were everywhere, and I loved that. Then I moved to Bathurst and you did the whole Central West, like from Lithgow right out back to where we met at Dubbo and down south, and then I moved up to Inverell, and Inverell was fantastic, and in those days the cotton was really kicking off in Moree, and so, you know, the state government wanted development out there, so we were always out there funding farmers going into cotton development. So that was quite a sophisticated thing. You know, they brought in big machinery, and cotton was the first crop they could forward sell, and you know, so that free market stuff was starting to come in there, and so I really enjoyed that. And then I mucked around overseas for a while in Africa and Europe, and then I came back and started selling houses in Grafton, working for my cousin, and then I liked selling houses, and then I started selling commercial properties, and then I just started putting our clients together to buy the bigger ones. And they wanted to buy out of town, so we just stepped that up and started buying in Coffs Harbour and Lismore and Port Macquarie and Tweed Heads, and then started buying in Brisbane. And because you run out quick, because if you don't own the big shopping centre in each town, there's maybe an office building or two or a shed, and then it's all owner-occupiers, so you've got to go to Brisbane to really find the product. Nearly everybody else I deal with started in the city, so they had that advantage over me, that they were already there and they understood how that worked and they had access to the services. So until we moved up to Brisbane with the right corporate solicitors and bankers, it was a slow go. But we did have access to the funds then, you know, that were coming in from people that were already in our business group, so to speak.
I'll ask you about that. What are the benefits of investing in regional assets as opposed to investing in metropolitan assets?
Metropolitan's better because there's more people, but regional works too, and we come from there, so you have to understand it a little bit better, you have to be a little bit more patient, and also it doesn't take much to influence the future of a town. One or two businesses shut down or the government withdraws something, it can affect that town and its values for quite a while. We'll continue to buy in the regions, but we'll continue to buy in the city as well, because the regions have been, you know, they were on their knees for a long time. You know, they didn't really enjoy the boom of the early 2000s, and then they've been slow to recover from the GFC. And now I think they're on the top of their game now, with everyone rediscovering what's there. But the thing that's changed it, in my view, is the NBN. It's been the greatest piece of infrastructure since bitumen roads in terms of decentralisation. So without the NBN, this working from home, COVID, move to the country thing would never have happened. And because the other infrastructure's not there. In the cities you've got options for your connectivity, but in the bush you haven't. So without the NBN, it was the single most significant piece of infrastructure, in my view, and it was a tragedy that it became a political football with those idiots changing it, right? All of yous, right? Because it should have been made bigger and faster and better. And it was a rounding error on the budget, you know, based on what they spent on JobKeeper and all that. So it was, you know, I couldn't say that I just got to stick that that's the best thing that happened and enabled all this to happen.
Reflecting on your career, what are the 2 or 3 key learnings that you can share?
Well, I think if you do what you like, that helps. If you like properties and real estate. So, you know, in the world I socialise in, everyone's in a bit of property to some degree, and so you sit around talking about property, you don't sit around talking about the football, or, you know, I'm not interested in the football that much, or the soccer, or the tennis, you know. Some people are, that's great, but you tend to find that's your hobby. So that, and the other one would be, if you want to get in, that then leads you into the next bit where you've got to get the right help. So when I wanted to get into corporate stuff, I needed to find corporate advisors. So if you're, you know, again, if you're from the city, you probably had a head start on that versus when you're coming from regional areas. But ironically, nearly everyone we use as a connectivity or conduit to get to it would have been from Grafton originally. You know, so that lawyer, they were from Grafton, they work in, you know, wherever, and you'd ring them up and then they'd be happy to help you, point you in the right direction. So it became a little bit like that. So, or when you're trying to get the information. So the right help and doing what you like, because if you don't like it that much, you're going to hate it. So pick something you like rather than something you don't like.
Question is, where do you go from here? I mean, where does the business Clarence Property go? Are you looking to increase your funds under management and your pipeline of projects? And the second part of that is, what's your outlook on the next 3 to 5 years?
Okay, so that's a very broad question. We've got about 500 million in rental properties and about a development pipeline of about 500 million or better, 600 on land we already own. So we don't have to go out shopping to buy it. So the townhouse projects, the hotel projects, the apartment projects, we've already got the land, it's all unencumbered, it's sitting there. So we either start to sell some of that and develop some. I don't think we're sort of geared up to develop it all. We've got more than we can take, and I don't want to go and build that massive infrastructure to try and deliver all this and create a bigger and bigger machine that's got to be fed all the time. But that's a massive opportunity for us. So moving into a bit more built form on the stuff we've already got, and we'll continue to buy land subdivisions. So we bought 5 this year, as I said, that total about 650 lots. That replenishes our land bank from selling down at Lennox Head and Casuarina. In terms of the business, we've got younger staff here now. Employed, you find when you employ a few people in their mid-30s that the enthusiasm lifts and the energy lifts. If everybody's in their mid-50, they're all getting tied together. So you've got to have that spread of ages. So you're out there trying to look for the next young people that are enthusiastic and like property, and expand our base. So I don't, we're always actively looking for board succession, executive succession, and that employing the younger people. There's no reason why we have to do anything else except slowly and steady continue to expand. So since the GFC, that was a bit rough. We're a lot more lowly geared now, and we sort of conduct this, we call it the brick by brick growth, so that we've, our walls nice and stable and solid. So we can continue to do that forever, I suppose. If not for me, I can't last forever, but if I keep employing younger people, there'll be someone there who wants to keep it going. It'll be identified.
So Peter, I want to ask you, in periods of financial uncertainty, what are the benefits for investors in investing in a property trust?
Well, in our world, we're unlisted. So by definition from ASIC, that means it's illiquid. And the advantage is that it's not liquid to some people, because liquidity gives you the opportunity to shit yourself. So we get around that by, when we take on someone's investment, we give them the full story directly. So there's no intermediaries between us and our investors. And if you put the time into them to explain what your product is, you don't have the trouble when you get a short-term or a big crisis, because you've explained to them how you operate. They know that if the building you buy, use their money, you collectively mobilise their capital to buy large buildings, and if those buildings are empty, there's no rent to share around. And so you go through that path. So we've never had the problem of people bang on the door or wanting to cash out, because we've explained to them how it works. And we don't, if they're real mad on liquidity, we don't take them on. You go and buy shares in Westfield or Mirvac or Stockline, you can sell them the next day. You go and, I use the old GPT shares from the GFC. They're $5.20. They raised at 60 cents, then they raised at 30 cents. Liquid, champ, go and sell them. Turn your $5.20 into 30 cents. That's a good investment, isn't it? It's liquid, you box head. So there's place for liquidity, but that's not our game. So we're long term. So go back to my point about the original investors. They've never taken any money out. They just know how much they're getting every month. It varies a little bit. If we have a hiccup, you send them a letter, explain it. They ring up, they ask about it. They're happy. And then subsequent to that, if someone wants to sell, we're always able to arrange it to sell their units to someone else. And we're able to maintain that for 27 years. It's worked fine. So the units transact, the people have got their money, they're gone. But predominantly, 9 out of 10 times when there's an estate, the beneficiaries keep the units. We just explain to them how they work. Every now and again, if they're younger, they'll be paying off a house or something and they'll want the cash. So sort them out with the cash and off they go. So the liquidity is a big spike, and it's a big issue when people invest, but it's an advantage sometimes. And if they split their investment, they can buy as many shares as they want, cash them the next day, buy them for $2, sell them for $1. Fantastic.
Absolute pleasure having you on the program this afternoon. Thanks so much for your time and your insights.
Thanks, Rob. I hope they were worthwhile.